Inventory is accounted for at cost and includes all expenditures necessary to acquire goods and place them in a condition ready for sale. After a company has determined the quantity of units of ending inventory, it applies unit cost to the quantities to determine the total cost of the ending inventory and the cost of goods sold. This process can be complicated if a company has purchased inventory items at different times and at different prices. To determine inventory, a company must select an inventory cost flow method. The methods are specific identification and 3 assumed cost flow methods: FIFO, Lifo, and average cost. We will illustrate each method using a TV company. If this company purchases 3 identical TVs on different dates at costs of $700, $750, and $800, the cost of goods available for sale is $2,250. During the year, they sold 2 TVs at $1,200 each. We need to determine which TVs are assigned to cost of goods sold as well as ending inventory. The cost of goods sold will differ depending upon which 2 TVs the company sold. In this example, beginning inventory is 0. During the accounting period, the company purchases 3 TVs. So we have 3 TVs totaling $2,250 available for sale. 2 TVs are sold, so 1 remains in our ending inventory. How we determine which amounts are assigned to cost of goods sold and ending inventory depends upon which inventory cost flow method we select. If this company can positively identify which units it sold and which are still remaining in ending inventory, it can use the specific identification method. If the company sold the TVs purchased on February 3rd and May 22nd, then its cost of goods sold is $1,500, $700 plus $800. Its ending inventory is $750, which represents the March 5th purchase. Specific identification requires that companies keep records of the original cost of each individual inventory item to arrive at the cost of goods sold and ending inventory. Even though technology makes it possible to do specific identification with nearly any type of product, this method is rarely used. Instead of keeping track of the cost of each particular item sold, most companies make assumptions about which units were sold. Because specific identification is often impractical, companies select other cost flow methods. There are 3 assumed cost flow methods: FIFO, Lifo, and average cost. These methods differ from specific identification in that they assume certain cost flows or make assumptions. The assumptions bear no relation to the actual physical flow of goods. They are merely used to assign cost to both cost of goods sold and ending inventory. The first in, first out FIFO method assumes that the earliest goods purchased, the first ones in, are the first to be sold. So they are the first to be recognized in determining cost of goods sold, regardless of which units were actually sold. In this example, the earliest purchases, the first ones in, are February 3rd and March 5th. So FIFO assumes the first ones in are the first units out or sold. So these costs are assigned to the cost of goods sold in the amount of $1,450. The most recent purchase on May 22nd of $800 is assigned to ending inventory. The last in, first out Lifo method assumes that the latest goods purchased are the first to be sold. Under this method, the cost of the latest goods purchased are the first to be recognized in determining cost of goods sold. In this example, the latest goods purchased, the last ones in, are May 22nd and March 5th. So LIFO assumes the last ones in are the first units out or sold. So these costs are assigned to the cost of goods sold in the amount of $1,550. The ending inventory is the first purchase on February 3rd for $700. The average cost method assumes that goods are similar in nature and uses a weighted average unit cost. The formula to calculate the weighted average unit cost is the cost of goods available for sale divided by the total units available for sale. If we take the total cost of goods available for sale, which is $2,250, and divide by the total units available for sale, which is 3 TVs or 3, we'll arrive at a weighted average unit cost of $750. The cost of goods sold and the ending inventory are assigned the same weighted average cost per unit of $750. So the cost of goods sold is $1,500. Again, that's 750 multiplied by the 2 TVs that we sold. And the ending inventory is $750, which represents 1 unit or 1 TV.